So welcome everyone. Right now we are going to study a very amazing topic, that is bank audit. In the bank audit there is a good topic which talks about SLR and CRR requirement, and sir, in this topic there has been one of a major amendment. There has been one of the major amendment which I am going to cover in this session. But don't worry, I have created these beautiful notes. I have created these beautiful notes for all of you, so that you get a good command, over this amendment. Sir, how can we get the notes? How can we get these amendment notes? So for those who are watching on YouTube, first of all, like this video so that it can reach to other CS students also. Done, sir. Now this notes you can find in the Google Drive link. In the Google Drive link that I'm giving in description, you will find all the amendment notes. Okay, sir. Talking about these handwritten notes that I have prepared, these will be available as a PDF on my Telegram channel. They will be available as a PDF on my Telegram channel, so you don't need to worry. Just sit and just watch this lecture. Acha, sir. Those students who have taken the batch, these notes again will be available in your batch ka Google Drive. Don't worry about it. Okay, sir. Now let's begin. With the amendment session. Are you ready? Yes, sir, we are ready. So first of all, let's discuss about the topic of SLR and CRR. CRR means cash reserve ratio. Sir, what is a cash reserve ratio? So let's say bank takes some deposits. Sir, these deposits can be in the form of current account deposits, saving account deposits, fixed deposit. Whatever deposits that the bank take, they are the liability of the bank. Yes or no? Yes, sir. So some portion of the deposit they are required to keep with RBI. Whom? RBI. RBI, that is Reserve Bank of India. So they say that the minimum fraction of the deposits should be in the form of cash or deposits be kept with RBI. Now, sir, how to deal with this? For this, you need to check with the master circular of RBI. Whatever is stated in the master circular of RBI, those directions need to be followed in this case. Is this basic point clear to you? Yes, sir. Now comes another topic, statutory liquidity ratio. Now, sir, what is a statutory liquidity ratio? Please try to understand. Let's say a bank has taken deposits worth rupees 100. Bank has taken deposits worth rupees 100. Now these 100 rupees ka deposit, there are some current account deposit, there are some saving account deposit, and then there are some fixed account deposit. Different types of deposits the bank has taken. Now, sir, when the bank has collected 100 rupees, they also need to give some loans. Yes, sir. So let's say the bank gave the loans of 100 rupees only. Oh my God. Bank gave the loans of 100 rupees only, and then the next day, one of the saving account depositor comes. One of the saving account depositor comes to withdraw the money, and the bank doesn't have any money. Bank says, we don't have money. Whatever money we got in the form of deposits, we have given the loan. Now tell me, everyone, will the saving account depositor will be affected? Yes, sir. Don't you think bank should have kept some portion in the liquidity form? Yes, sir. They should have kept some form in liquidity form, and the remaining portion they must have given as an advance. So this is what this concept of statutory liquidity ratio says. The name itself is statutory liquidity ratio. Statutory liquidity ratio means it is required by law. That's why it is statutory. Liquidity means whatever deposits you take, some portion you need to keep in the form of liquid assets. Some portion you need to keep in the form of liquid assets. It can be cash, it can be gold or other approved security. Liquidity needs to be maintained. And the remaining portion you can lend to the other parties. That you can give as an advance to the other parties. So it says you are required to maintain. You are required to maintain gold, cash, government approved securities, basically the liquid assets. Basically other liquid assets, and the report on this needs to be submitted to the top management and RBI. So now, sir, how the things work, everyone focus here. This part we have already covered. So now, as an auditor, what do I need to check? As an auditor, what do I need to check? Baba, you just need to check two things. First of all, the deposits wala liability. Deposits wala liability means there are three types of deposits: current account, saving account, fixed deposits. Yes, sir. If I talk about the current account and saving account, can I say the person can withdraw these amounts? Person can withdraw these amounts anytime on their own demand. Yes, sir. Since these amounts can be withdrawn anytime on the own demand, these are called demand liability. Got it, sir. If I talk about the fixed deposit, they are there for a definite time. So these are called time liability. So together they are called demand and time liability. Everyone say with me. Together they are called demand and time liability. That is, Cutely we say them DTL, demand and time liability. Current and saving accounts are demand liability, fixed deposit are time liability. Now a percentage of the DTL needs to be maintained in the form of liquid assets. So you are going to just check the calculation of DTL and whether proper liquid assets are maintained or not. Yeah, let's continue. So, sir, what do we need to do? Everyone just look here. The concepts are very simple. The concepts are very simple, easy to understand. Just focus here. Okay. So it says RBI must have RBI must have given some instructions and guidelines. Yes or no? Yes, sir. So as a auditor, you just need to verify the compliance with the RBI's instructions and guidelines. Okay, sir. Sir, for this, you need to select 12 dates randomly. You need to select 12 dates randomly and remember it should not be Fridays. These should not be Fridays, sir. Why it should not be Fridays? Arey Baba, for the Fridays we have movies. We have new movies coming up. So for that we need to go for that. Bad joke, sir. I will tell you the logic. Just wait for a minute. So it says that the auditor needs to select 12 odd dates which should not be Fridays. Other than Fridays, we need to select the dates for checking the SLR compliance. Now, sir, it says as a central statutory auditor, as the head office wala auditor, you need to ask the branch auditor to submit the trial balance for the purpose of consolidation at the head office. So basically what will happen, let's say there are many branches, branch 1, branch 2, branch 3. All of them will submit their trial balance for the purpose of consolidation at the head office. Got it, sir. So remember one thing, this consolidation wala work already happens on Fridays. So on Friday, the SLR requirement are checked at head office. So what we should do? We should select the dates other than Friday. Other than Friday. Because on Friday, everything will be all right logically. So if normally everything is all right on Friday, we will select the date other than Fridays. Got it? Got it, sir. So on these dates that the auditor has selected, he will examine the cash balance. He will examine the cash balance on the selected date. Now the question comes, sir, why the cash balance? Why the cash balance? Arey Baba, you are checking the SLR, that is liquidity ratio. And cash is the most liquid asset. So you need to check the cash balance on these dates. So if I tell you, it's a very simple thing. RBI instructions and guidelines to be checked on 12 dates, which should not be Friday. Got it, sir. Branch auditor will submit the trial balance for consolidation on Fridays and the dates which are selected by auditor other than Friday. Got it, sir. On these dates, also request the branch auditor to examine the cash balance. Is the liquidity wala part checked? Yes, sir. Now we will focus on the DTL wala part, that is demand and time liability. Now understand one thing, whatever is the total liability of the bank, whatever is the total liability of the bank, and if you want to calculate the DTL liability, you need to exclude some things. If they are already included, understand na? If these things are already included in the liability wala portion, you need to exclude them. Got it, sir? And if these things are not included, you need to include them in the DTL wala position. You are getting the point or not? Yes, sir. Now everyone focus here. What are the things which need to be excluded? So first of all, they say whatever is the, see, understand the concept behind this part. Whatever is not of liability nature, will be excluded. Got it, sir? If something is of liability nature, but the liability is not of that nature that you need to refund it back, you need to pay it back to the depositor. That means that liability is not in the nature of current account deposit, saving account deposit, or fixed account deposit. If that liability is not of the nature of current, saving, or fixed deposit, again it will be excluded from here. Got it, sir? And even if it, let's say, it is in the form of some type of deposit which need not be refunded back, which need not be given back to the depositor, then also it will be excluded. So three types of things will be excluded. One which is not a liability, one which is not in the liability of the nature of a current, saving, or fixed deposit, and last one is a type of liability which need not be paid back, to the depositor. It can be adjusted from his receivable balance. Now how the things work, each example we will cover along with the proper logics. Everyone focus here. So first of all, they say these are the paid up capital, reserves, PNL, and credit balance. Are they liability in the nature? Answer is no. So they will be excluded. Now, sir, in case you have taken some big loans, in case the bank has taken some big loans from Big banks like RBI, Export Import Bank, National Housing Board, NABARD, that is National Agricultural Board for agricultural and rural development. So if there is a National Agricultural Bank for agriculture and rural development, so such type of loans will also be removed. Similarly, if there is a Small Industries Development Bank of India, then that loan will also be removed. So since these loans are not in the nature of current saving and fixed deposit, they will be excluded. Got it, sir. Paid up capital, reserves, profit, not in the nature of liability. Big loans from big banks, not considered as deposits. Now, sir, next part. Let's say bank has created some provision for doubtful debts. Whatever advances it has given to the public, it has created some provision. Now, sir, out of that provision, if there are some recoveries, do you think the recoveries should be deducted from the provision? Yes, sir. Whatever provision I have created, I thought that the money will not be recovered. Now, when the money is recovered, it should be deducted from the provision. Yes, sir. So it will also be excluded. It will also be excluded. Got it, sir. Now, sir, what is the next point? Everyone, please try to understand. Let's say a bank paid for the importer $100. A bank paid for the importer $100. Now, the importer returned to the bank rupees 8,000. Sir, how did he return rupees 8,000? So, importer took the rate $1 is equal to 80. $1 is equal to 80, and this is not the final rate, this is the provisional rate. This is the provisional rate that the importer took. Now, sir, this bank paid how much? $100. How much the bank got? 8,000. So liability should be set off? I said no. Liability did not set off because this is given on a provisional basis. So this 8,000 that the bank has got now, he will keep in the form of sundry deposit. He will keep it in the form of sundry deposit, yes, that is also a liability. And why they have kept in the sundry deposit? Because the final exchange rate is pending. Somewhere the final exchange rate is pending. Now tell me one thing. When the final exchange rate will come? Now in the future, let's say the final exchange rate comes. When the final exchange rate will come, this liability will be set off. This liability will be set off when the final exchange rate comes, because when you get to know the final exchange rate, accordingly you can calculate how much money do you need from the importer, how much more money do you need from the importer, and out of this maybe how much money you are required to return. So can I say this liability is again not in the nature of current account? No, sir. Saving account? No, sir. Fixed deposit? No, sir. So that's why it is also excluded. That's why it is also excluded. So that's what it says. Amount received in rupees against the import bills. This is kept in sundry deposit. Why they are kept in sundry deposit? Because the final exchange rate is pending. Got the concept? Yes, sir. So till now, three amounts excluded: paid up capital, reserves, and P&L credit balance, not a liability. Then big loans from big banks, liability, but not in the nature of current, saving, and fixed deposit. Got it, sir. Part recoveries from provision, deducted from the liability. And then, sir, then we have amount received in the import bills where the final rate is pending. Now, sir, let's move to the next point. Sir, what does the next point says? What does the next point says? Everyone, please focus here. Just give me a moment. Sir, now what does the next point says? Everyone try to understand. Okay, sir. See, how does the dividend payment works? First of all, understand this part, then you will understand the concept. So what happens is, let's say ITC Limited wants to give the dividend to the shareholder. ITC Limited wants to give the dividend to the shareholder. So there are two ways of giving the dividend to the shareholder. Either give it directly as a credit to the shareholder's bank account, or ITC can also issue dividend warrants. See, practically this thing is not applicable, but theoretically it is. Theoretically this is there. So directly you can credit to the shareholder's bank account, or you can give the dividend warrant which can be given. Now, sir, the whole responsibility of issuing the dividend to the shareholder is given to the SBI. This is given to the SBI's ka link branch. So what ITC does, it credits the amount of dividend to the SBI ka link branch. Got it, sir. And then the SBI ka link branch can give it to the shareholder in two forms, either direct credit to the shareholder or through a dividend warrant, or it can be done through a dividend warrant. Got it, sir. Let's say shareholder got the dividend warrant. And he submitted to the dividend warrant to the SBI branch, but it is another branch. This is a different branch. This is a different branch. When he gave the dividend warrant to the another branch, branch made the payment to the shareholder. Branch made the payment to the shareholder. Got it, sir. When it made the payment to the shareholder, it should have informed the SBI link branch. Yes, sir. It did not inform. It did not inform the link branch. So can I say in the link branch, there is still a liability? There is still a liability for which the payment has been made by another branch. Payment has been made by another branch. So do you think it should be a part of the liability of SBI? Answer is no. It should not be a part of the liability of SBI. So just understand one thing, what happens in the first stage, ITC Limited get credits the dividend to the SBI ka link branch. Got it, sir. Then, sir, shareholder could have got it as a direct credit to his bank account, but he got it through the dividend warrant. So shareholder submitted the dividend warrant to the SBI ka another branch. Another branch made the payment, but it failed to inform SBI ka link branch. It failed to inform SBI ka link branch. So this amount is not adjusted. So this dividend ka amount is still unadjusted. So do you think this unadjusted amount should be a liability for the bank? Answer is no. Why, sir, it is not a liability? Because shareholder has already got his share of payment. Shareholder has already got his share of payment. So this is what is given in this concept. Please understand. Unadjusted deposits or balances. Unadjusted deposits or balances which are lying in which branch? Link branch. For example, dividend. To the extent that it is paid by other branch has already made the payment. Got it, sir? And it is not adjusted by the link branch. Why link branch has not adjusted it? Because it failed to inform the link branch. Is the concept clear to you? Yes, sir. Now let's move to the next part. Sir, what is the next part? Everyone try to understand. See, every bank gives some funded facilities. Every bank gives some funded facilities in the form of advances. Now let's say the bank has taken a security of rupees 100, but it gave the advance of only rupees 90. Sir, why only 90 and why the security of 100? Baba, it needs to keep some margin. It needs to keep some margin of 10 rupees. Got it, sir. So bank already has 10 rupees of the borrower. Bank already has 10 rupees of the borrower. Yes, sir. Now let's say the borrowing is for 3 months. And after 3 months, the borrower is required to pay rupees 90 plus the interest amount. Now let's say after 3 months, the due amount is 99. Borrower's due amount is 99, but we already have the margin of rupees 10. Yes or no? Yes, sir. So borrower is required to pay only 89. Borrower is required to pay only 89. Now tell me one thing. This margin that you ultimately set off from the due amount, as a bank, are you required to pay it? Are you required to pay it as a liability? Answer is no. Such type of liability is not to be paid. It is just to be adjusted. It is just adjusted from a future receivable from the borrower. It is just adjusted from the future receivable of the borrower. So, sir, can I say it is not in the form of a current account deposit? No, sir. Saving account deposit? No, sir. Demand liability, time deposit? No, sir. It is not a demand and time liability. So that's why it is excluded. So this is the same thing they have written. If a bank has taken some margins which they have kept in the form of a sundry deposit for the funded facilities for whatever advances they have given, it will also be excluded. You're getting the point or not? Yes, sir. Till now, whatever points we have covered, let me give you a trick to remember it. Sir, yes. These points you can call as PP Munni. What, sir? PP Munni. What do I mean by PP? Everyone mark the points so that when we are solving the question, you are in a very good position. I have got a good question for you. Let me show you. See everyone. So this type of question has already been asked by ICI in November 24 exam. So whatever new adjustments have been added by ICI, I will be covering in this question. So everyone study properly. Got it, sir. So what I was discussing was PP Munni. So first P means P for paid up capital. P for paid up capital, reserves and P&L account and loans from big banks. Second P means part amount of recoveries from the provision. So whatever recovery, deduct from the provision. Now, sir, what is Munni? M for margins. Margins in the sundry deposits for funded facility, which will be later on adjusted only. Now, sir, what is Unni? Un means unadjusted deposits and balances. Unadjusted deposits and balances of the link branch which has been paid by the other branch. And sir, I for import bills. In case of import bills, even if the importer has returned the money, even if importer has returned the money, you keep it as a sundry deposit. Why, sir? Final exchange rate is pending. When the final exchange rate is pending, so this is I. I hope the PP Munni wala part is clear. Yes, sir. Now we will increase the technique ahead. Now just focus with me on the remaining parts. So what does the next part says? Let's say the bank got a bill discounted with the RBI approved financial institution. Can I say bill discounted is also a liability? Yes, sir. Whenever I discount the bill with the RBI approved institution, bill discounting means I have a bill receivable. This receivable is receivable after 3 months. I don't want to wait for 3 months. I don't want to wait for 3 months. So what do? I take the bill, go to a RBI financial institution, get the money right now. Get the money right now, and then this money will be due after 3 months only. It will be my liability after 3 months only. So it says if you have got a bill discounted by a RBI approved financial institution, so tell me one thing, is it a demand and time liability? Answer is no. It is neither a current account, it is neither a saving account, neither it is your fixed deposit. So again, this will be excluded. This will be excluded in this case. Got it or not? Yes, sir. We got it. Now comes the next part, that is the net income tax. Net income tax provision. What is a net income tax provision? I hope you understand the income tax provision. Yes, sir. What is net? What is net? So net means all the liability. That is the current tax liability, direct deferred tax liability, and then minus all the tax credit. These tax credit can be in the form of TDS. It can be in the form of advance tax. All this will be excluded. So whatever is the net liability, whatever is the net liability of income tax, that will come here. Got it? Again, the income tax provision is not in the form of a demand and time liability. It will be excluded. Now, sir, next point comes amount that is received from DICGC. I hope you understand what is a DICGC. Yes, sir. Deposit Insurance Credit Guarantee Corporation. Deposit Insurance Credit Guarantee Corporation. So, sir, what is the concept of this? Please understand. Let's say as a depositor, I have kept rupees 10 lakhs. I have kept rupees 10 lakhs with ICICI Bank. Now, sir, tomorrow, let's say ICICI Bank gets bankrupt. ICICI Bank gets bankrupt and all the monies are gone. Now, sir, what will happen to the depositors like me? My hard earned rupees 10 lakhs are there with ICICI Bank. Do I have an insurance for that? Answer is yes. Whatever money that you keep with the commercial banks, 5 lakhs of insurance is given by DICGC. So that insurance is available. So let's say the bank got bankrupt and they got the insurance amount from DICGC for the depositor. They got the insurance amount from DICGC for the depositor. So do you think it is in the form of current account, saving account, fixed deposit? Answer is no. It is a different type of liability. So that's why it is also excluded. Similarly, if they have got some amount from ECGC, that is Export Credit Guarantee Corporation, insurance company, or any court receiver on behalf of some depositor and all, then sir, that amount will also be excluded. Remember this. Next point says, let's say the bank has done some derivative transaction. Derivative transactions can be futures and options. And on that derivative transaction, there is a unrealized loss. Here they have written both gain or loss, but generally the net unrealized loss will be your liability because that is something to be paid. That is something to be paid in future. Now understand one thing, what is a net unrealized loss on derivative? So unrealized loss on derivative can be, let's say I bought a shares ka future. I bought the futures of a share. So the share can be ITC. I bought the futures of ITC. I thought that the share price will go up. But Indian people became health conscious. They stopped drinking the cigars and ITC price came down. Now, sir, when the ITC price will come down and I have not sold the shares, it will be an unrealized loss because I have bought the shares at higher amount. Now the price has come down. There is an unrealized loss until I sell the share. Now, sir, this unrealized loss is like my liability. It is like my liability which I have to pay to the company. So, sir, this is something you need to realize. Whenever there is an unrealized loss on derivative transaction in the trading portfolio, it is also a liability, but not in the nature of current, saving or fixed deposit. It is also excluded. Just last two more points. And the things will be done. The next point is the advance income. See, a bank gets a lot of income from the depositors in the form of some annual fees or other charges. So in case they have got some annual fees or other charges which are non-refundable, these are not to be refunded back. These are not to be refunded back. They have already got it. So Baba, they just need to provide the service. They don't need to refund it back. So again, it is in the form of liability, but it need not be given back to the depositor. So it is removed from the DTL wala part. And last part, sir, please understand everyone with me. Look at the photo. So, sir, what happens? In this photo, there is an importer, there is an exporter. Importer wants the goods from the exporter, these goods with a 90 days credit period. Got it, sir. Now the exporter is worried whether the importer will pay the money or not. So it asks the bank of the importer to give a guarantee. Guarantee in the form of banker's acceptance facility. Come on, say with me. Guarantee in the form of banker's acceptance facility that if the importer doesn't pay, we will pay in the 90 days. We will pay in the 90 days. Now, sir, what happens now? Let's say the importer defaults. Let's say the importer defaults. So can I say now it becomes the bank's liability? Yes, sir. Now tell me one thing. Is this liability in the nature of current account? No. Saving account? No. Fixed deposit? No. So it is not in the form of DTL. So this is what it says. Liabilities due to utilization of limit under banker acceptance facility will also not cover under this. So you will say PP Munni, let's say it is a girl, cute girl. Let's make the girl. So this is PP Munni. Now with more points, this is PP Munni. Oh my God. Sir, this is a big PP Munni. So in Hindi, what do we call big? Sir, we call big as PP Munni has now become very buddy. PP Munni buddy ho gayi. So we say PP Munni buddy ho gayi. That means PP Munni has become big. Now, sir, what is buddy? Let's understand the point. See, you have understood it. But to solve the question, you need to also remember, acha, these things were to be excluded. Buddy means B for bills discounted. B for bills discounted by the RBI approved institution. Next, B means bankers acceptance facility. Bankers acceptance facility, if there is any liability, excluded. A for advance income. A for advance income, which is non-refundable. Remember, this is not refundable. Got it, sir. DDI. What do you mean by DDI? D means DICGC. Any amount received from DICGC, ECGC, or you can say an insurance company or court receivable, not a part of liability. And second last point is derivative transaction unrealized loss, and I for net income tax. Whenever there is a net income tax provision, that also becomes your another type of liability. I hope the PP Munni buddy points is clear. Yes, sir. All the points are done. These are the liability. So, sir, how do we know that PP Munni buddy has to be excluded from the liability? Because now she is buddy. Now, sir, she will do the education. She will do the education. She will get a good job. So when she does the education and does a good job, she becomes a good asset for the family. She becomes a good asset for the family. She does the education, she does a good job. So she becomes an asset for the family. So when PP Munni has got buddy, she should be excluded from the liability and become an asset. Okay, this is how logically you can remember. A good point, sir. Now everyone take 2 sips of water. Take 2 sips of water. We are just left with now another point. Everyone please focus here. Yes, sir. Take 2 sips of water. Now we will cover the inclusion. Inclusions are very easy. Just I need your 5 minutes and all the inclusions will be done. Everyone ready? Yes, sir. So the first inclusion says, there are only 3 or 4 points. That's it. First inclusion says if there is a net credit balance. Net credit balance in the branch adjustment account. Branch adjustment means this is the amount that you owe to the other branches and the head office. Okay, sir. So this will become a part of liability. Now remember one thing, if there are credit entries which are outstanding for more than 5 years, that you will consider on gross basis. Gross basis means if there is any receivable, you will not deduct it from it. For example, let's say there is a payable of 100 which is outstanding for 6 years. Is it more than 5 years? Yes, sir. And there is also receivable for the other branches for 40. What will be your liability? 100 only. You will consider it on gross basis. You will not deduct the 40 which is receivable. So this is what they have written. In the net credit balance of branch adjustment account, include in the liability. If there are credit entries outstanding for more than 5 years, consider it as gross basis. Okay, sir. Now, sir, whenever there is an interest accrued on deposit, it should be calculated on fortnight basis. What is a fortnight basis? So in Jaipur, there is a very famous fort. And at night, you need to calculate the interest. Bad joke, sir. Sorry. So fortnight means on a 2 weekly basis, or you can say 14 days basis. Okay. So interest should accrue on deposit on a fortnight basis, and whatever interest accrued, it becomes a part of the deposits ka liability. It becomes a part of deposits ka liability. Did I say due? No, sir. I did not say due. I am saying the interest is accrued. Now understand, sir, there are certain collateralized derivative transaction. What is a collateralized derivative transaction? Please try to understand. Let's say there is a company. Yes, sir. And company enters into a interest rate swap with a bank. And for this interest rate swap, can I say it is like a derivative? It is a derivative. AFM feels. For this, the company gives a cash collateral in the form of a security. It is in the form of a security. Got it, sir. Now let's say what is the interest rate swap? Company will pay the fixed rate of 7%, and the liability is floating rate of LIBOR plus 2%. Bank's liability is LIBOR plus 2%, company's liability is 7%. Now based on this, the interest rate swap's value can increase or decrease. And sir, company has given the cash collateral in the form of security. You understood the point? Yes, sir. Now everyone just try to understand, whatever cash collateral I have received as a bank, whatever security I have received as a bank, will I need to give it back to the company? Answer is yes. This is your liability. This is your liability which you will have to pay back to the company. Since it has to be paid back to the company, it has to be included in the DTL wala part. It is included in the DTL wala part. Now many of you may say, sir, in the margin also, in the margin for funded facility also, it was in the form of a security. But Baba, you need to understand, this security that you was keeping, this margin that you were keeping, you were adjusting with the receivable amount. Here there may be a case there is no receivable amount, there may be a case there is no receivable amount. Yes or no? Yes, sir. Still in that case, you will have to return this cash collateral back to the company. So if you are required to return the cash collateral back to the company, Baba, you have to include it in your liability. Now sir, next point says, whatever borrowings the bank has taken from abroad, that is the foreign borrowings, these are just like the liability to others. You can also call them adverse balance of nostro account. They say that they need to be considered at gross level. Again, they need to be considered at gross level. So in case you have any asset with that bank, you have any receivable with that foreign bank, that receivable cannot be set off. Whatever is the payable, that only will be shown at the gross level. So in case of Indian banks, obviously, in case of Indian banks, you can net off with the assets, but in case of foreign banks, you have to show the gross position of payable. Got it? Got it, sir. Now comes the next point. Sir, we need to scrutinize the Nostro account. Why, sir? Let's say in the Nostro account, there are some inward remittance for the customers, for the employees or something like that. That is also liability for the bank. So yes, that will be included in the DTL wala part. So liability wala part is very easy. Credit balance in the branch adjustment account, interest accrued, even if not due, will be included on fortnight basis. Cash collaterals in a collateralized derivative transaction will be a part of it. Got it, sir. And similarly, we have done any borrowings from outside India. Any borrowings from outside India will become a part of it. Yes or no? Yes, sir. So this is all about it. Now, sir, there are some exempted category. Please understand. If a bank has taken some loans, if a bank has taken some loans in the form of minimum eligible credit or long-term bonds, and what is the purpose of the loan? The purpose is to finance, focus here. Purpose is to finance infrastructure loans for the country, housing loans for the country. So it is a good development for the country. So if the bank is developing the country, these will not become a part of the DTL calculation. These will be exempted from the DTL calculation. Got it, sir. Next point says, if there is a eligible amount of FCNR bank account. What is a FCNR bank account? Foreign currency non-resident account. Foreign currency non-resident account, that means any amounts which are receivable in foreign currency like dollar, euro, pounds, which will be a part of this account. Or there is a INR accounts of the non-resident, that is non-resident external account, which have the maturity of 3 years and above. Or sir, after 3 years, the person will come to take the money. So if there are certain foreign accounts like FCNR account, NRE accounts, which have a maturity of 3 years and above, don't need to include them in the DTL calculation. No need to include them in DTL condition, because 3 years is more than enough. 3 years is too much, sir. The person is not coming today to take the money. So, okay, we will not include them in the DTL calculation. Okay, sir. Now remember that you need to verify these loans in the form of reporting in Form A. Form A ka reporting ka return, you need to verify these points, because sir, these need to be submitted to RBI. So on this, MCQ can be asked. Got it, sir. Second thing is, if this FCNR account is in four currencies, what are the four currencies? Dollar, pound, euro, Japani. Say with me, dollar, pound, euro, Japani. In this, Japani means yen, Japani yen. For converting it to INR, you will use the RBI ka reference rate. Which rate you will use? RBI ka reference rate. Sir, what if there is a other currency? For this, you will use the New York rate to convert to USD. Once you have converted to USD, how do you convert to INR? Using the RBI reference rate. So very, very easy. For these four currencies, you will use the RBI reference rate. For other currencies, first of all, you will use the New York rate, get it to USD, and now sir, for USD to INR, you again use the RBI reference rate. These things I am discussing with you because I think ICI is very naughty. ICI is very naughty. They can ask you these things in the form of good conceptual MCQs, so you should be aware about all this. Done, sir. So here your whole bank audit amendment is done. I think everything I have discussed very clearly with you. Last may just remember these three other points. Sir, what? Examine whether the consolidations prepared by the bank include the relevant information of all branches. So just remember that the consolidation should include all branches. These 2 points are enough. Also remember, see that the balances of the branch adjustment account of foreign branches are also considered while arriving at the net balance of branch adjustment account. And last may just for MCQ purpose. Just for the MCQ purpose, please remember that for CRR, there is a form A return, and for the SLR, there is a form 8 return. So A and 8. Say with me, A and 8 both are rhyming. Both are rhyming. So this should be done. Now everyone, are you people ready for the question? Yes, sir. If you have still not liked the video, it is very bad. Do like the video, yeah, and subscribe the channel because you will get really good content here. Now everyone focus here. Let's focus on the calculation of the value of demand and time liability. Sir, DTL balance as on 30th September was 50,000 crore, which included the following. So all these things are already included in the liability. So included means whatever you are required to exclude, now you have to exclude that. Whatever you are required to exclude, you just need to exclude that. That's it. So tell me first of all, PP Munni Buddy ho gayi, that we need to exclude. So can I say P for paid up capital, reserves and PNL account? All of them are not in the nature of liability, so they will be excluded. Yes, sir. So 27,016501210 will be excluded. Then I said loan from big banks. Loan from big banks, that is RBI, Exim, NHB. These are the big banks. This will also be excluded. Got it, sir. So all these points are excluded. That I'm doing the yellow, dirty fellow. Now, sir, PP, another P was part amount of recoveries. Part amount of recoveries from the borrower debts which were considered bad and doubtful, it will also be excluded. Net credit balance in branch adjustment account. Was it to be excluded or included? Sir, it was to be included, but it is already included. Do you need to include it again? I said no, just ignore. This point will just be ignored. That's it. Now, sir, interest accrued but not accounted in the books. Again, it was to be included. It is already included. Ignore. Margins held in sundry deposit for funding facility. Munni, M for margins. So can I say margins were required to be included? Yes, sir. We were required to be excluded. We will exclude them. Now, sir, बड्डी हो गई. बड्डी में I was income tax provision. I was income tax provision. So there is an income tax provision. You need to exclude it. Then, sir, cash collateral received from a customer who got an interest rate swap. This cash collateral needs to be refunded back, so it will be included in the liability. So again, ignore because it is already included. Amounts which are received from ECGC by invoking the guarantee. But D for DICGC, ECGC. DICGC, ECGC insurance companies. We discussed na Baba. I said don't forget. Amount which are received from DICGC, ECGC, insurance company, court receivable, they were to be excluded. So we will exclude 120. Got it, sir. And then, sir, it says annual saving account fees received in advance. But D, A for advance. A for advance, this again income needs to be excluded. Why, sir? This will be excluded from the liability because this advance is not payable. It is not payable again by the bank. And last point says bankers acceptance facility liability. Bankers acceptance facility liability. So B for buddy, B for banker acceptance facility. This will also be excluded. Now let's calculate the total net position of DTL. Let's calculate the net position of DTL. Everyone please calculate with me. 20. We'll start with 50,000. 50,000 minus 27,000 minus 1650 minus 1210 minus 575 minus 480 minus 125 minus 80 minus 40 minus 120 minus 15 minus 5. So it comes out to be 18,700. It comes out to be 18,700. So this is how ICI can ask you a good conceptual question either practically or in the form of MCQ. Got it or not? Yes, sir. So this is your DTL balance that I have just calculated for you. For all the updates and all the documents like this, do join the Telegram channel Clear CA with Shubham Keswani. I give all my updates on this channel and I just make sure that you get the best quality content. You get the best quality content with an element of fun. And that's the power of learn with fun. Got it or not? Yes, sir. If you like the video, do give it a like and yes, stay subscribed to the channel. And yeah, do let me know in comments how was it. Okay. Keep studying with happiness because when you study with happiness, then only you progress. All the best. Keep going.